Lance Roberts here with 3 minutes on markets and money about how to navigate extended bull markets. Look, I get lots of emails about, well, where the markets are now. How do you add money to the markets? Well, first of all, we've got to talk about a couple of things. Buy and hold and dollar cost averaging, those strategies work great when you're in a rising trend of the bull market. The problem is when you go through a decline, through a bear market, dollar cost averaging and buy and hold destroys capital and takes you away from your investment goals. We showed this chart previously, which shows a 6% annual compounded rate in the markets versus $100,000 actually invested. The deviation between the two lines shows the shortfall of actually reaching your retirement goal. So the important thing about investing is avoiding the big downturns in markets. With valuations very high on multiple levels, this suggests that forward returns on portfolios are going to be substantially lower in the future. It also suggests that, well, we may be in tow for a bear market at some point as we go through what's called a mean reversion cycle. On a technical basis, we are more extended now in the markets than basically just about any other point in history. So when you start combining the volatility, the technical extensions, as well as valuation measures, it's certainly concerning about, well, adding money to a market here. But as portfolio managers and as investors, we need to make money while markets are rising. So, well, how do we do this? I mean, we take a look at the markets where we are today. We're in the latter stages of bear markets. Earnings are declining. Economic growth is weak on several fronts. Markets are extremely stretched. So looking at the strategies, how do we navigate? How do we add money to markets safely at this point, but still control our risk? First is move slowly. There's no rush to putting money into markets. We can take our time, pick our points where we want to put money to work. If you're heavily underweight equities at this point, just begin by adjusting your current equities to get them somewhat aligned to your model. But again, moving slowly. Begin by selling laggards and losers. Things that have not worked in your portfolio probably aren't working for a reason. And if we do get into a bear market, they're going to perform even worse. And lastly, add to sectors and positions that are working. We have a motto here at our office, which is do more of what works, less of what doesn't. Always have a point where you're going to exit a position. When you know you're wrong, admit you're wrong, move on. So stop loss levels are important. Also, technical trends are important, so follow the technical trend of the market. If it's rising, be invested. If it's not rising, well, it's time to reduce risk. Also, there's nothing wrong with cash. If you simply don't know what to do, don't do anything. Just hold some cash. When you have the right opportunity, put the cash to work. And if none of this makes any sense at all to you, hire an advisor, a portfolio manager, somebody who knows how to manage risk and manage your money. It'll be worth the expense that you pay longer term. This article, along with all of our other analysis on our website, realinvestmentadvice.com. It's 3 minutes on markets and money. I'm your host, Lance Roberts.